All right. Hello, everyone. Welcome to this episode of Market Shares. I'm your host, Tony Blodgett. And today I got kind of a smorgasbord of things to talk about. We're going to talk about interest rates. We're going to talk about inflation. We're going to talk about conforming loan limit changes because there's been some interesting news kind of transpire this week. But I think we need to start with the elephant in the room, which is mortgage interest rates. And I say it that way because if you watch this podcast on any sort of regular basis, you know that I did a whole episode about how there's just no possible way that interest rates could get to 9% like some of the doomsdayers seem to be saying on other YouTube channels. And I called it clickbait. I call it, never going to happen. But yet look at what mortgage interest rates have done just over the last few weeks. I mean, look, they were already super high. And then during this last Fed meeting, Jerome Powells said some things that really, I think, shook the market. There's always been this thought that, look, the Feds have to fight inflation. We all know this. They're going to be raising interest rates in order to slow down the economy. But Jerome Powell made it very clear in his last statement and then the Q&A that happened afterwards that, regardless of the amount of pain that it may put into the marketplace, they will not stop raising interest rates until they see signs that inflation is coming down. And it was very strong language. Matter of fact, there was one question in particular that was asked regarding, support for mortgage interest rates. And, the Fed has not only stopped purchasing mortgage backed securities, but are starting to and have been letting runoff happen in their portfolio, their holdings of mortgage-backed securities, putting more supply into the marketplace and further exacerbating the situation with mortgage rates. And there was some question as to whether or not Jerome Powell planned on doing anything to kind of help mortgage interest rates stay affordable. And he essentially said, there's nothing in the future. There's no talks about that. It's not even on the plate right now. It's not even something they're discussing. So it was just very clear if you watched that 45-minute or so statement and then the Q&A afterwards that he's going to be aggressive. And the market, felt it. And as a result, we saw mortgage backed securities just tumble the next day by over, I think it was 140 basis points. That was, I think, on a Thursday. Friday, it looked like we might be stabilizing. And then Monday comes and we drop another 100 basis points. And then it's just been a whirlwind since then. So much volatility in mortgage rates, creating a lot of challenges. I'm going to talk a little bit about some of those challenges that have happened as a result of this. But the bottom line is that rates now have screamed up to, somewhere close to 7%. And then all of a sudden people are like forwarding me, my own clips saying, are you sure it's not getting to 9%? I mean, gosh, we've sure come up a lot. But I am here to tell you that I still stand firm in my belief that mortgage interest rates are not going to 9%. Matter of fact, I'm going to guess we've now seen the highest rates that we're going to see. Now, is it possible that we run up and test these levels again? Sure. It's certainly possible. There's a lot of things that are unpredictable about how mortgage interest rates move. But it's my belief that we've seen the high watermark as far as interest rates go. We've actually seen some improvements this week. Again, a lot of volatility, but definitely overall some improvements this week with mortgage interest rates. But let's talk about some of the challenges that have been created by these huge moves. And what you probably notice if you're in the mortgage business is that it's becoming more and more difficult to find a par interest rate. Now, I think as this week kind of went on, most of our capital markets teams and even the Fannie and Freddie, started publishing higher interest rates and whatnot. But look, the reality is that it's very difficult to feel comfortable offering a mortgage rate in the mid seven range, even upper sevens, and feel like you're ever going to get a return on that on that security, because the chances are that there's going to come a time in the not too distant future where you can refinance that loan. And so if you think about it from the lender's perspective, they provide this mortgage with the thought that they're going to be collecting payments over a period of time. And so that's the servicing value of that loan. And so when you look at a loan and how many points are available in that loan, it typically a lot of the value has to do with the fact that there's going to be the ability to collect payments over a long period of time. And you would think as interest rates go higher that the servicing value goes higher, and in theory it should. But we're in a market right now where I think everyone realizes that this is probably going to be short-lived, and there's going to be an opportunity to restructure or refinance these loans down the road. And so as a result, I used the analogy the other day, just think about if you were going to sell someone a car and it was going to just be on a private note. You were going to finance it for them, but you knew with a very high level of certainty they were going to default on that loan. Well, you would probably want to get more of your money up front instead of trusting that they're going to make those payments. Well, it's the same sort of thing here. A refinance is certainly not a default, but look, there is a schedule of time that lenders expect to get paid, like the life cycle of a loan. And when it doesn't go through that full maturity, they lose out on a lot of the revenue they expected. So as a result, they want more of their money up front. And that's what you're seeing with the lack of premium pricing. And for a lot of borrowers with, really perfect credit and, good down payment and so on and so forth, it's not that bad. But when you get into situations where you have a borrower with a lower FICO score, typically you see higher interest rates for that. And so the cost goes up, and there's no room to raise the rate any higher to cover that cost. And so that has to be paid upfront many times in the form of discount points. But then there's other features as well. If you're doing a cash out refinance, there's typically an additional charge for that. If you're buying an investment property or a second home or a condominium, all these things have what are called loan level price adjustments, which drive up the interest rate. And normally you can cover those costs by simply raising the interest rate, and it covers those costs. Well, in this market, there's no ability to do that. So you have a lot of investors, people buying second homes, people with lower FICO scores that might be purchasing condominiums, as an example, might have to, come in with multiple discount points in order to secure that loan. And it's making it very difficult. So the good news is that we're in a market where negotiating with the seller is definitely more prevalent right now. So you can negotiate to have the seller help cover some of these costs on many of these loans. Doesn't work so much with investment properties, but because there's a cap on how much the seller can contribute towards your closing costs and whatnot. But nonetheless, there are strategies around it. But if you're seeing that happen on your rate sheet, just know that this is happening kind of industry-wide, and it takes a while for the market to catch up. And we even saw on government loans, so Ginnie Mae securities, FHA, VA, USDA, where there wasn't even coupons above 6% that were even trading. We have seen some 6.5 coupons open up, but even those don't have a lot of stability to the price. And so it's really difficult even on government loans. And if you can imagine, you have first-time home buyers using an FHA loan, it's already a low 3.5% down payment. And then if they have to pay points on top of that in order to secure that loan, it can really make it difficult. So this market is proving challenging for all of those reasons. But the good news is I think that it's stabilizing as the week has gone on. We're seeing higher interest rates now available so that you can absorb some of those costs. I think there's more opportunity to, as I mentioned, negotiate with the seller to help cover those costs. And I think that interest rates, like I said, have kind of peaked. And I think we're going to see them still stay high for a period of time. But then as we start getting to the end of 2022 and into the first part of 2023, I think it's likely that we see interest rates come back down. Certainly not to the levels that we saw them before, but probably back into the 5s and maybe even the high 4s as we move into the end of the first quarter of next year. That's what I'm seeing predicted. And the reason for it is really pretty straightforward. It's because inflation looks like it's going to start coming down. And the reason why I can have some level of certainty about this is because inflation, although it's presented as an annual number, it's really a culmination of the last 12 months of inflation reports. And we can look back 12 months ago and we can see the inflation numbers that we had in June, July, and August of 2021. And we knew that those numbers were really low numbers. And so although inflation looks like it's, still high, but a little bit better in June, July, and August of 2022, the number is replacing a much lower number in 2021 during that same time. So the annual number has still been going up. But the last really high reading that we expect to see is going to be the September number. And then after that, the numbers that are getting replaced as the impact of the Fed moves and the loosening of the supply chain challenges and just the overall economic situation is going to lend itself towards lower inflation numbers. You couple that with the numbers that are being replaced from the latter part of 2021, which were higher inflation reads, the overall annual number is going to look a lot better as we start moving through the fourth quarter. And you can kind of see this. What you can't see, of course, is what do the future inflation numbers look like. But all indications are we're going to start seeing some softer readings, and they're going to be replacing some higher readings from a year ago, and that's going to give us an annual inflation number that looks favorable, and it's probably going to give the Fed the confidence they need to slow down the interest rate increases. And look, we all know that it takes some period of time for these interest rate increases the Fed has done to really take hold anyways. So chances are we continue to see some pain. We see some impact of these Fed rate hikes even after we start seeing inflation start to curb a little bit. And that's normal. And that's why most people believe that the actions that have already been put in place are going to create, and Jerome Powell said the word pain a lot in his speech. We're going to create some pain in the market. We're going to slow things down. So we know that pain's coming, and it typically presents itself in a recession. And so that's more than likely what's going to happen, and then interest rates will come down. So I'm going to go out on a limb here and say I'm standing behind my deal that rates won't get to 9%. One of the things I talked about in that episode was how attractive fixed income assets are right now. I mean, I don't know if you know this, but if you don't, you should look into it. Many banks right now are offering like preferred deposit accounts, which aren't even like a CD. They're just a preferred deposit. I have some money in a preferred deposit account at my Merrill account. It's not invested in the market, but it's earning almost 3%, 2.93%. There's some 1 or 3 year CDs that are up over 3%, close to 4%. I suspect that you're going to find some 1 year treasury bonds that are available, especially after the next Fed rate hike, probably in the mid 4s. So look, I mean, just like I was saying, you're seeing a lot of money flood into these fixed assets that return a fixed amount of income. And it's not enough to outpace inflation, but it's certainly attractive when there's so much volatility in the stock market. There's talks of a recession. There's all these concerns in the financial markets. Bitcoin's doing no one any favors right now. So look, if you get 4.5% rate of return, it's becoming a very attractive investment. And you guys, like I said, when more money goes into these bonds, whether they be treasury bonds or mortgage-backed securities, because the rate of return they're now yielding, that in and of itself drives the rates back down. So it's happening just like we described. So anyways, that's my take on interest rates. Let's talk a little bit about conforming loan amounts really quick, because this is interesting. So there's been this thing in the mortgage industry the last couple of years where everyone tries to predict what they think the new Fannie Mae, the FHFA, the Fannie Mae and Freddie Mac new conforming loan amounts are going to be. And this information is typically not announced until November, but here we were this year, and everyone at the end of September is trying to guess what they think the number's going to be. And I think it was Rocket Mortgage was the first one to come out with these new conforming loan limits. And then, of course, everyone rushes to file suit. And so conforming loan limits right now in most places across the country are $647,200. Now, that was an increase of $98,950 from 2020. So from 2021 to 2022, the conforming loan amounts went up by almost $99,000, and currently sit at $647,200. So what happened is that a couple weeks ago, Rocket came out and announced we're going to start offering 2023 conforming loan limits at $715,000. And all of a sudden, everyone's looking at the math and deciding, yeah, 715 sounds like a pretty good number. Well, what happened this week, it's kind of funny if you want my opinion, is that the July, it's called the Federal Housing Finance Agency House Price Index. So the FHFA HPI is the index that everyone's looking at. And when the most recent number came out, it actually went down just a little bit. So all of a sudden everyone goes, oh, you know what? Maybe we don't quite get all the way to 715,000 in 2023. And oh boy, what's going to happen with all these loans that we're now offering if we can't sell them conforming? Now, if you're in a high price market it's not that big of a deal. You can sell them as a high balance loan, but hey, that isn't the case all around the country. So anyways, what we're seeing right now, we saw, matter of fact, PennyMac was the first correspondent lender that I saw that removed their 715 limit, and they dropped it back down to 700. And now we're starting to see many lenders follow suit. I've seen some at 705, 700. Look, it still could be 715, but it's definitely not a for sure, because I think there's one more report that's got to come out, one more reading on that index before they announce the final number. And if that's down again, it's possible we don't hit the 715 number, and that's why lenders are kind of scrambling. So I think it was, it's just kind of hilarious to me, that everyone rushes so much to put these out. Then here this year, they're having to correct themselves. So don't be surprised if your company or the company that you might broker loans to or correspondent, if you see that loan amounts got dropped from 715 to 700, now you know why. The FHFA HPI index was down just a little bit. Just so you know, at 715,000, that would be a 67,000 increase from the 2022 numbers. So quite a bit less of an increase than what we saw from 2021 to 2022, but still a huge increase in conforming loan amounts. And then one last thing that I wanted, that I thought was kind of interesting, we talk a lot about inflation right now, but I want to put this in perspective for you. I was playing around on an inflation calculator before I hopped in the studio here to shoot this, and I was just curious, what would $100, so if you had $100 in 1922, how much would that be worth today? And there's a calculator online. This is kind of fun. You might want to go look it up. Just Google inflation calculator. But $100 in 1922, adjusted for inflation, it would be $1,762.92 in 2022. So $100 is $1,762. So that's a 1,662.9% increase in the last 100 years, which, if you do some quick math, is 16.63% inflation per year. That is much higher than what I expected to see. Now, I thought that it would be fun just to look at 2002 until 2022. So just the last 20 years. And this is kind of what I expected. Over the last 20 years, $100 is now worth $164.63, or a 3.23% appreciation over the last 20 years annually. Now, we know that the Fed's target number is around 2%, right? That's the goal. They're raising rates right now to try to bring inflation back down to about 2% annual inflation. I thought it was interesting that the last 20 years has been at about 3.23. So it's been pretty tame, really. But I was surprised. I don't know if you are. Are you surprised that the last 100 years is 16.63% annually? That's a big number. The numbers that we're looking at right now, by the way, are around, I think, 8.3% is where we were at in August. And so anyways, I think that we're through the worst of inflation. We might see one more reading that ticks up a little bit as we get through the next 30 to 45 days. But I think after that, you start seeing the readings come down. Hopefully the Fed will start slowing their rate increases as we get towards the end of the year. And we can get back to a little bit of normalcy in the market. One reminder though, and there's a lot of talk about this right now, which is when is the right time to purchase a home? I am telling you that I still believe that right now is the best time to purchase a home. And the reason why is because there's options. There's more listings on the market. Now, granted, there's always more inventory this time of year. So this is normal behavior. So let's not be too surprised at the ramp up of inventory. But nonetheless, there is more inventory. Part of it has to do with market conditions. There is no doubt. We are seeing more price reductions from sellers. But the good news is you can negotiate a buy down, whether it be a permanent buy down of your interest rate. Sellers are willing to negotiate with you. So you don't have to settle for the high interest rates that are available today. You can negotiate with the seller to help pay that. If you're confident that rates are going to come down at some point in the near future, you can have the seller pay for a 2-1 buy down, which is going to give you an even lower interest rate for a short temporary period of time. It's a great option for a lot of people, depending on your situation. You can also negotiate potentially to have closing costs covered. But besides all of that, really the bigger reason why now is a great time is because there's options. You get to find the home that meets your family's needs. And I can tell you, as someone who's lived in a home that I just didn't love, you know, when you get into a market where you have to settle for whatever is available, you know, it takes that pride of home ownership and it takes it down just a notch, because every night you have to drive home from work and go to a home that you just don't love. And so right now there's opportunities with more to choose from, better opportunities to negotiate. It's a great time to purchase a home. Look, will the market continue to soften a little bit? Probably. But look, if you're looking to buy something and live in it long-term, now's the time, because as rates come back down, the challenges that we saw over the last couple of years with inventory will come back. There is not enough homes to house all of the households being created in the United States. There's just not. It's a simple supply and demand thing. And as the market calms down and inflation gets under control and interest rates drift back down, we will be back to a very feverish housing market. And if you waited on the sideline thinking you were going to save a bunch of money, I think you're going to be surprised. And if you're concerned about the interest rates today, then I would just tell you that you can always restructure your financing, and there's plenty of ways to get creative and work with your lender to come up with a strategy to help negotiate a deal with a seller that's going to give you pretty favorable terms, even in this high interest rate market that we find ourselves in. So that's the episode for today, you guys. I hope that was helpful information. You know, we'll see if I'm wrong. I'll put out another, if rates get to 9%, I will eat crow and I will come on here and we'll talk about what went wrong and how could I be so far off. But don't worry, those of you who are worried about my fragile ego, don't worry. I'm going to stand behind my message. We're not getting to 9%. And I think the worst is behind us, although it's going to continue to be a challenging market, I think, for the next handful of months. But with everything that's challenging, there's opportunity. So hopefully you find those opportunities. Hopefully you find this program and this information helpful. If you do and you haven't subscribed yet, what are you doing? Subscribe. Tell your friends, please tell your friends in the mortgage industry or the real estate industry that they should check out this show, because we're always dropping good, relevant information. And I hope this was helpful for you. And until next time, thanks for your time and attention. Bye for now.